European stocks hit record highs and bond yields rise as higher defence spending is priced in amid Ukraine peace talks. Japan's economy hits its growth stride and high dairy prices and a low Kiwi dollar are combining to support New Zealand's economy. That's coming up in our 5 Things in 5 Minutes for Tuesday, February the 18th. And then in today's bonus deep dive interview, ANZ Australia senior economist Adelaide Timbrell explains why the improving inflation outlook has given the Reserve Bank of Australia the room to cut its cash rate by 25 basis points to 4.1% later today. And then, once more, in August.
Because of all of that resilience in economic activity that I had mentioned before, as well as those really strong labour market outcomes that we've seen and that we expect to continue, the Reserve Bank is going to be very cautious about its rate cut. So we are still expecting just 2 rate cuts in the cycle, one in February and one in August.
But first, in 5 and 5 with ANZ, European shares hit record highs overnight as investors flocked to defence stocks amid expectations for greater military spending after news of the Ukraine peace talks. US markets were shut for President's Day. At 4 a.m. Sydney-Melbourne time, Europe's broad Stoxx 600 index was up 0.6%, while the yields on European government bonds also rose as investors priced in expectations for higher spending. ANZ head of G3 Economics, Brian Martin, says discussion of joint European defence bonds by the French supported rising bond yields.
The US and Russian officials are holding talks in Saudi Arabia at the moment to see whether or not talks can progress about a peace in the Ukraine. There are some concerns that the US might be downplaying its role in European defence in the future. And I think it was those comments about European defence spending by the Europeans that really garnered support for the stock market today. But it wasn't just defence stocks. European bank stocks rose as well. They were up over 1%. So all in all, a good day for European stocks despite the huge uncertainties that are prevailing at the moment.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was trading up 0.07%. The Aussie dollar was up 0.27% at 63.65 US cents, while the Kiwi was up 0.28% at 57.36 US cents. Number 2. After decades of misfiring, Japan's economy is finally generating some growth and inflation that is forcing the Bank of Japan to put up rates. Data yesterday showed Japan's fourth quarter GDP growth of 2.8% from a year ago was much stronger than market expectations for 1.1% growth from a year ago. Here's ANZ FX strategist Felix Ryan.
Even when we look at the broader data in Japan regarding consumption and wages, it does look like things are turning strongly in the positive direction. So household consumption data for December showed a very strong 2.7% year-over-year lift. And it seems for some time now, wages growing at quite a strong rate as well. So all that does support the notion that consumption and activity in Japan is certainly getting to rebound, does support that outlook that we have the Bank of Japan normalising policy further in 2025.
Number 3. Growth was also higher than expected in Malaysia in the fourth quarter. Here's ANZ economist Arindam Chakraborty explaining why the 5% growth figure for the fourth quarter is likely to moderate from here to around 4.5% in 2025.
Exports and investments are expected to grow at a softer pace as indicated by the weaker growth in intermediate and capital goods imports. Moreover, the uncertainty over trade policies and a maturing tech cycle will also weigh on capex. We think the onus of growth will shift to household consumption this year. That's mainly because the labor market has remained resilient, with the unemployment rate falling to its lowest since 2015. Moreover, government policies like the increase in civil servant salaries and upward revision in the minimum wages are supportive of consumption.
Number 4. Now, there's one part of the New Zealand economy that's doing very well at the moment, dairying. Here's ANZ New Zealand Chief Economist Sharon Zollner.
Dairy prices have done extremely well, setting up potentially a pretty good payout next year as well as this year. And the New Zealand dollar has remained under pressure and dairy production has been strong. So that's a pretty unusual mix for dairy farmers of high prices, high production, but a low currency. It's the dream combo, really. So that's positive from a national income point of view. And of course, the weaker New Zealand dollar does put upward pressure on that tradable inflation. That's not the part of inflation the Reserve Bank focuses on.
Number 5. There's another tiny group of businesses who have also had a very busy couple of weeks. Florists and jewellers leading up to Valentine's Day. Sharon has dived into ANZ's card spending stats in New Zealand to find out what's happening this year. Jewellers saw their turnover double on Valentine's Day from a normal day, while florists, they sell 8 times more than normal on Valentine's Day, and they're back near their pre-COVID levels. Jewellers, though, are not. Here's Sharon.
Certainly whether spending money on Valentine's Day is a necessity or a luxury, there might be a range of views on that. But it's, flowers are a lot cheaper than jewellery. So I think that goes some way to explaining why the spending on jewellery hasn't matched that 2021-22 period. But also back then, travel and experiences were logistically challenging. And so we did see people substitute from services and travel and things to goods. So you get a spa instead of a holiday in Fiji, and perhaps you buy a ring rather than taking your beloved to Fiji for the weekend. I think that probably that explains why jewellers' spending still hasn't matched those COVID years.
Sharon Zollner there. Now, in today's deep dive interview, ANZ Australia senior economist Adelaide Timbrell tells my colleague Alex Tarrant about why the improving inflation outlook has given the Reserve Bank of Australia the room to cut 25 basis points to 4.1% later today.
We're already in momentum terms in the right spot when it comes to inflation. We do now think that trimmed mean inflation in its annual rate, not its annualised 6-month rate, will come back into the band by mid-2025, a little bit earlier than we previously expected. Now, this is really encouraging. We think inflation momentum is at a point now where a February rate cut is very likely, but because of all of that resilience in economic activity that I had mentioned before, as well as those really strong labour market outcomes that we've seen and that we expect to continue, the Reserve Bank is going to be very cautious about its rate cut. So we are still expecting just 2 rate cuts in the cycle, one in February and one in August. The Reserve Bank's mandates are to have inflation between 2 and 3% and to maintain full employment. Based on the Reserve Bank's most recent analysis, we're likely, in their view, above full employment, where there's actually less unemployment than what they would consider an equilibrium. But I don't think that's going to be the decider for them to not cut rates in itself, but certainly it will make them very cautious in terms of how many times they cut rates through the cycle, because when there is a very tight labour market, it can produce reinflation risk. If the unemployment rate gets so low that people are really having kind of bidding wars for workers, that can create wage growth that becomes unanchored, which can create inflation risk. We don't think that the labour market is at that point now. In fact, we think the labour market is closer to full employment than what the Reserve Bank have determined. When it comes to inflation, there will be some bumpiness in the headline figures. That's because of the electricity subsidies rolling on and off. So headline inflation will be a little bit bumpier, but when we look at the trimmed mean that takes out those volatile series, we're seeing a pretty good trend in the right direction at the moment, which we do think will continue, and that the trimmed mean inflation number will be in the middle of the target band through most of 2026.
Now, I guess risks to forecasts are often balanced 50-50, but what major risks do you see sort of either way for the headline forecasts?
Risks to the forecast for the Australian economy, of course, we have to look globally when we think about the uncertainty at the moment. So if there was, for example, escalations of conflict due to tariffs or a trade war, for example, that is something that could both impact the inflation numbers and our economic activity. China's slowdown and other risks to our commodities prices can also put a bit of a damp on economic activity, and some of those flow-on effects could happen there. But overall, these are very fresh forecasts. The risks are generally balanced. And I think at the moment, the inflation is encouraging enough that we're not seeing great risk in the very near term of reinflation. But given the tightness of the labour market, we're always looking at that potential productivity growth and potential wage growth to understand whether that reinflation will happen. At this stage, it doesn't seem like a risk. Wage growth has eased. It's not in a range that would be considered concerning for business costs being passed on to consumers. And although we do expect a consumer recovery, it's not a boom for the consumer. It's merely a reversion from a very weak period. And what that means is that rather than consumers getting overexcited and causing reinflation or contributing to reinflation because businesses are able to charge more when there's lots and lots of customers, we're really just seeing people loosen the purse strings a tiny bit after having to tighten and tighten and tighten them over the last few years due to that inflationary pressure.
Adelaide Timbrell there, speaking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, February the 18th. Catch you tomorrow with all the detail and analysis from the RBA's rates decision and a look ahead to tomorrow's BIGS rate decision in New Zealand. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.